Welcome back to Letters of Intent. I'm Pankaj Raval, founder of Carbon Law Group, and today we are breaking down one of the most fascinating corporate restructurings of 2026. Elon Musk is back again, now consolidating SpaceX and xAI into a reported $1.25 trillion enterprise.
And we're not treating this like a tech headline. We're treating it like what it is, a related party consolidation with fiduciary implications, capital markets consequences, and potentially serious tax structuring components.
Yes, Sahil. I mean, this isn't just rockets meeting AI. I mean, there's probably already a lot of AI being used to design the rockets and vice versa. A lot of rocket science going into maybe even the AI. But this is governance, this is dilution, and this is valuation engineering. There's a lot of corporate gymnastics that here to make this merger happen, and we're going to get into it.
And to me, this looks like possibly a tax-free reorganization. We're talking about private companies here, so we don't know. We're not able to completely look behind the veil, but we've done these tax-free reorganizations before, these types of acquisitions between related parties. And so you can see what the machinations are that are probably going on behind the scenes.
So just take us back and like what actually happened here. So in February 2026, SpaceX acquired xAI in an all-stock transaction, meaning there's no cash consideration. And that led to xAI becoming a subsidiary of SpaceX. The combined valuation was reported at approximately $1.25 trillion, 1.25 trillion with a T, with xAI valued internally at around 250 billion. But Sahil, there's something to be said about these valuations, right? I mean, do we need to take them as truth, or do we take them with a grain of salt?
Grain of salt, especially whenever you hear all stock transaction. Your corporate antenna should go up because stock for stock exchanges often signal something very specific in tax law. And especially when we're talking about these kinds of valuations, these valuations are not between two parties negotiating at arm's length. These are related parties. So you've got to take this with a grain of salt.
Yeah, I mean, I think, and also just looking at Elon Musk, I mean, he's notorious for doing this, right? You have to look at what he's done in the past. He acquired, when he merged xAI and X, or formerly Twitter, he valued Twitter or X at $33 billion, which is way above what anyone else would have valued it at because he was trying to recoup some of the losses. But the reality was that he had lost so much revenue from advertising and people fleeing the platform that the value of X was actually substantially less. So here, he's really just making up numbers, inflating them to make it look like some incredibly valuable company, ideally to probably take public, but the reality is it may be much different.
That's absolutely right. There's a level of financial engineering here that is important to understand, and I want to highlight this section that we're going to talk about next for our clients and our audience, because even as a small to mid-sized business, you can take advantage of the tax strategy here. So let's explore if this could be a Section 368 reorganization under the Internal Revenue Code, under the IRC. So under Section 368A1, certain mergers and stock acquisitions qualify as tax-free reorganizations. That means shareholders can exchange stock without recognizing immediate gain. There are four different types. Type A, statutory merger. Type B, stock for stock acquisition. Type C, asset for stock acquisition. And finally, reorganizations under Section 368A1F for mere changes in identity or structure. If SpaceX acquired xAI solely in exchange for voting stock and met continuity requirements, this could potentially qualify as a Type B reorganization, the stock for stock acquisition.
So Sahil, the question is like, why does it even matter? This is a pretty complex stuff, but I guess understanding Section 368, I think for our listeners, it means that there's no immediate capital gains tax for xAI shareholders, which is important. Their basis carries over, meaning that the value of their stock in xAI now carries over to SpaceX, and also there's a continuity of interest in their equity, and then the transaction is tax deferred, not tax exempt, meaning they'll still have to pay tax at some point, but just not now, which is super powerful. And now they get to be part of another company also that actually has significant revenue and has probably the most value here out of all his companies. SpaceX is making billions and billions of dollars a year with these government contracts, and it has huge potential. So I think this could be very big win and fall for the investors.
Absolutely. And if we think about it in the alternative sense, if xAI had actually been sold for cash at a $250 billion valuation, shareholders would likely face massive taxable gains. So stock for stock avoids that immediate tax event. It allows you to see how companies treat their stock as a currency. So the same way you can trade currencies, you can trade stock. And so you don't actually need cash to make an acquisition. Your stock has a share price and a value, and there are tax advantages to using that currency to making acquisitions.
Absolutely.
And so I want to apply this to small and mid-sized businesses, some of our clients who we've actually done this for. So you could imagine a founder who owns an operating company, separate IP holding company, and maybe a software subsidiary. Instead of selling one to the other for cash and triggering tax, they can structure a stock for stock merger that qualifies as a tax-free reorganization. So the benefits here are no immediate gain recognition, preserves equity value for future liquidity, simplifies the corporate structure, consolidates IP and operations, avoids transaction level tax drag. This is incredibly common in pre IPO cleanups and in private equity roll ups.
Interesting. So this is all pretty complicated, but I think it's very important for people to understand when you're growing a company, building a company, and you want to maybe merge it with a new entity. This is one really valuable mechanism to do this. And it isn't magic. There's really clear guidance on how you can qualify under Section 368, which means like you need generally a continuity of interest, meaning there has to be some overlapping interest between the entities, continuity of business enterprise. Yeah, they have to continue the business enterprise there, which I don't see as an issue. Valid business purpose and compliance with statutory merger mechanics, which there's a few that you have to look into. But again, these are things that we guide clients on, and generally we don't recommend people do this at home. Just like if you see any kind of stunts on television, we don't recommend doing this without the supervision of a licensed professional. Managing your corporate governance and structure is the same.
Absolutely. This is why there's a ton of documentation that matters. We work with entrepreneurs all the time who just generally say, okay, we want to do this, but don't realize that each of those companies has its own set of bylaws or operating agreements. Each of them have requirements related to approvals from stockholders, unit holders, or a board of directors or the board of managers. And you have to accurately paper this documentation in case you're audited. I mean, this is in order to ensure that the IRS treats your transaction as a tax-free reorganization, you have to make sure this is papered properly.
Absolutely. Another important thing for our listeners to remember is that if you have a large company or if you have even a growing company, that you do have certain fiduciary obligations to your shareholders. You do have fiduciary obligations to maybe the board. If you're on the board, maybe you have other fiduciary obligations. So that means you have an obligation to treat people with fairness, not to self-deal. So under Delaware law, when a controlling shareholder causes one entity to acquire another entity that controlling shareholder also controls, the courts will apply something called the entire fairness rule or analysis, which they look at process and the price. So even if the tax treatment is optimized, governance must still withstand scrutiny as far as making sure that this deal is fair to the shareholders.
Definitely. There's a corporate governance component here, especially if we want to get into interested director transactions, which certainly this is going to involve interested directors. You're going to have related parties. So DGCL section 144 comes in, and interested director transactions can be managed if they're properly approved or they're considered otherwise fair. So even in private companies, the best practice is to have some type of independent review, because if the entity goes public later, you want to make sure that lawyers can revisit this exchange ratio. So to break it down, Pankaj, we've gone over what a tax-free reorganization is and how our clients and our listeners can take advantage of that too. I want to kind of summarize what Musk is actually doing here. He's centralizing governance, he's reallocating dilution, he's potentially using tax-free reorganization rules, he's broadening valuation comps, and he's increasing optionality. So after the consolidation, the company can IPO as a unified AI space platform, spin off divisions later, use consolidated equity for acquisitions, and raise capital more efficiently. So effectively, we just want our audience and our community to know your stock is a very valuable asset because you can use it as a currency. So treat it that way. There is a level of gamesmanship that emerges when you're playing at this level, and there are lessons that we can pull from this for our clients as well.
Absolutely. So, in closing, Sahil, corporate law doesn't prohibit ambition. It encourages it, but, you have to do it within the frameworks of the law. And that's what a lot of people don't really recognize. It can be complicated to decipher the Delaware code or California code. And you have to understand that there are limits to power. There are limits to how power is exercised.
And tax law doesn't prohibit restructuring. A lot of people think the tax law is engineered to be adversarial, but in many ways it incentivizes certain behavior, certain forms of continuity like this.
So, Sahil, the moral of the story is that when you negotiate with yourself, you're the controlling shareholder of of two separate entities with different shareholders, whether your company's $1 trillion, $1 billion, or $1 million, governance, valuation discipline, and tax structuring must align.
Definitely. And this kind of engineering is very helpful, but it has to be papered properly. And that's where we come in as the legal architects.